Imagine a world drowning in complexity, a world where every day a new technology emerges, promising to revolutionize everything we know. We hear about artificial intelligence, quantum computing, gene editing, decentralized finance. The language is dense, filled with acronyms and jargon designed to sound impressive, to sound like the future. We are told that to succeed, to build wealth, we must understand these things. We must invest in the next big, complicated thing before anyone else does. And so, the average person, the retail investor, the aspiring entrepreneur feels a constant nagging pressure. A pressure to keep up, to learn the jargon, to pretend to understand business models that are, in reality, as clear as mud. They listen to experts on television, they read dense analyst reports filled with charts and projections that stretch years into a hypothetical future, and they feel a sense of intellectual inadequacy. They think, if I don't get this, I'm going to be left behind. This feeling, this fear of being left behind in a world of accelerating complexity, is one of the most destructive forces in modern finance. It is the siren song that has led countless ships of capital to crash upon the rocks of bankruptcy and ruin. It convinces good, intelligent people to hand over their hard-earned money to ideas and companies they do not, in their heart of hearts, truly understand. They are buying a story, a dream, a piece of the future, but they cannot articulate in simple terms how that dream will translate into cold, hard cash. Now imagine a different world, a world of radical simplicity. Imagine an investor, perhaps the most successful investor in human history, sitting in a quiet office in Omaha, Nebraska. He's not reading white papers on blockchain consensus mechanisms. He's not building complex models to project the user growth of a pre-revenue social media app. He is, instead, reading the annual report of a company that makes bricks, or a company that sells furniture, or a company that makes chewing gum. His desk isn't cluttered with monitors flashing real-time stock quotes. It's covered in company reports, newspapers, and bottles of cherry Coke. This man is Warren Buffett, and his entire philosophy, the bedrock of a fortune that defies comprehension, can be distilled into a single, devastatingly powerful principle. A principle so simple it sounds almost childish. He calls it the fifth-grader test. The rule is this: when buying a business or a piece of a business in the form of a stock, look for one that is so simple, so straightforward, that you could explain to an average fifth grader in less than 2 minutes exactly how it makes money and why it will continue to make money for a very, very long time. If you can't do that, don't buy it. It doesn't matter if the company is on the cover of every magazine. It doesn't matter if your smartest friend is telling you it's the next big thing. If you cannot pass the fifth grader test, you walk away. This isn't a guideline. It is an iron law. This principle is not about dumbing down your investment strategy. It is about elevating it to a level of clarity and conviction that 99% of market participants will never achieve. It is a filtration system, a mental razor that cuts through the noise, the hype, and the jargon to reveal the durable, cash-generating heart of a business. It prevents the single most costly mistake an investor can make: getting seduced by a story you don't fully understand, making it impossible to assess the real risks lurking beneath the surface. Adopting this one rule, this one simple test, will fundamentally transform your relationship with your money. It will build unshakable confidence in your portfolio, because for the first time, you will only own businesses whose money-making process is crystal clear to you. This clarity is your shield. When the inevitable market panic arrives, when the screens are flashing red and the so-called experts are screaming, "Sell," you won't flinch. You won't sell. Because you will understand with absolute certainty the fundamental source of your investment's value. And that, right there, is the secret to true long-term investing, to surviving the storms, and to achieving the kind of portfolio growth that leads to genuine financial freedom. This is the final promise of simplicity. Our journey into this principle begins with its cornerstone, the very idea from which all of Buffett's success flows. It is the concept of a circle of competence. This isn't just a quaint phrase, it is the blueprint for a powerful and profitable investment strategy. To understand it, we must travel back in time, not to a frantic Wall Street trading floor, but to a quiet candy shop in California, a place that would teach Buffett and his partner Charlie Munger one of their most enduring lessons about the immense power of staying simple. The year was 1972. Berkshire Hathaway was still, in many ways, a transformed but humble textile mill. Buffett and Munger were actively looking for wonderful businesses to buy outright, not just stocks to trade. They were introduced to a family-owned business based in Los Angeles, See's Candies. See's was, and is, the epitome of a simple business. They make chocolates and other confectionery treats. They sell them in their own stores, primarily on the West Coast. A fifth grader could grasp this business model in 30 seconds. They make candy that people love, people buy it, especially during holidays, and the company makes a profit. There are no patents, no complex technology, no esoteric software algorithms, just sugar, chocolate, and a deeply ingrained brand loyalty. The founding family, the See family, wanted to sell. They were asking for $30 million. At the time, See's had about $4 million in pre-tax earnings and held about $8 million in tangible assets, things like factories, stores, and inventory. Buffett, the disciplined value investor, initially balked. Paying $30 million for a business with only $8 million in physical assets seemed outrageous. It violated the classic cigar butt investing he had learned from his mentor, Benjamin Graham, which focused on buying companies for less than the liquidation value of their assets. This asking price was nearly 4 times the tangible book value. His mind, trained for a decade to look for statistical bargains, screamed that this was too expensive. But Charlie Munger saw something else. He saw an invisible asset that wasn't on the balance sheet. He saw the power of the See's brand name. He understood that when people in California thought of giving a box of chocolates for Valentine's Day or Christmas, they didn't just think of candy, they thought of See's. This brand allowed the company to have pricing power. Every year, they could raise the price of their chocolates by a little bit, and their loyal customers wouldn't even think of switching to a cheaper alternative. The experience of walking into a clean black-and-white See's shop, getting a free sample, and buying that familiar gold box was a tradition, a part of the cultural fabric. Munger pushed Buffett to look past the simple numbers on the page and see the simple, but incredibly powerful, business reality. This was a business they could understand completely. They understood the product, they understood the customer, they understood why the customer kept coming back. It was well within their circle of competence. After some negotiation, they agreed to a price of $25 million. It was the most Buffett had ever paid for a business relative to its tangible assets. And he later admitted he was nervous. He felt he was overpaying. That $25 million investment has since returned over $2 billion in earnings to Berkshire Hathaway without requiring significant additional capital investment. It was, as Buffett would later call it, the prototype. It was the business that taught him it was far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And the key to identifying that wonderful company was that it was blindingly, beautifully simple. They knew everything they needed to know about the candy business to make a sound executive decision. They didn't need to guess about technological disruption or shifting consumer fads. People had been eating candy for centuries, and they would likely continue to do so. The simplicity of the business model allowed them to see the enormous, intangible value of the brand, an asset that has compounded their wealth for over half a century. The story of See's Candies is a perfect illustration of why staying within a circle of competence is a cornerstone of any successful long-term investment strategy. But what is happening on a neurological level that makes this principle so effective? It's a direct counterattack against one of the most pervasive and dangerous cognitive biases we face as human beings, the Dunning-Kruger effect. The Dunning-Kruger effect, identified by psychologists David Dunning and Justin Kruger in 1999, is a cognitive bias whereby people with low ability at a task overestimate their ability. In simple terms, it means that we are often too ignorant to recognize our own ignorance. In the world of investing, this is financial poison. An investor might read a few articles about cloud computing, learn a few buzzwords like SaaS and hyperscaling, and suddenly believe they are qualified to pick the next great software stock. They mistake familiarity with jargon for genuine understanding. They see a stock price going up and assume they understand the underlying business. when in reality they are just following momentum. They are standing on the peak of what Dunning-Kruger called Mount Stupid, a place of high confidence and low competence. Buffett's fifth grader test is a deliberate mechanism to force yourself off that dangerous peak. It shatters the illusion of knowledge when you force yourself to articulate a business model in language a child can understand. You strip away all the jargon, all the buzzwords, all the vague promises of future greatness. You are left with the naked, unvarnished reality of how the business makes money. If you can't explain it simply, it's not because the business is too sophisticated, it's because you don't actually understand it. You are in the danger zone of the Dunning-Kruger effect. This self-awareness, this intellectual humility, is the most powerful tool a retail investor can possess. It protects your capital from your own worst enemy, your overconfidence. It forces you to admit, "I don't know," which are the three most important words in wealth management. The world is full of people who lost their savings investing in biotech companies without a background in biology, or in complex financial derivatives they couldn't explain to their spouse, let alone a fifth grader. They weren't stupid. They were simply victims of their own brain's tendency to overestimate its own competence outside of its specialized domain. The circle of competence is the fence you build to protect yourself from this innate and costly psychological flaw. So how do we translate this powerful psychological insight into a practical, repeatable process? How do you, as an individual investor or entrepreneur, build and operate within your own circle of competence? This is the applied mental model, the blueprint you can use starting today. Step 1 is to perform an honest self-inventory. Take out a piece of paper or open a document and draw a large circle. Inside this circle, you will write down the industries and business models that you genuinely understand on a deep, fundamental level. This isn't about what's popular or what's making headlines. This is about your life experience, your career, your passions. Did you work in retail for 10 years? You probably understand inventory management, supply chains, and consumer branding better than 99% of Wall Street analysts. Put retail in your circle. Are you a software engineer? You have a massive edge in understanding software business models, even if you should still apply the fifth grader test to avoid overly complex niches. Put certain types of software in your circle. Are you a doctor or a nurse? You understand the healthcare system, medical billing, and the value of certain medical devices. Put that in your circle. This is not an exercise in ego. It is an exercise in brutal honesty. The goal is not to have the biggest circle. The goal is to know precisely where the perimeter of your circle lies. As Buffett himself says, what's important is not how big the circle is. What's important is staying within the circle. Step 2 is to use this circle as your primary hunting ground for investment ideas. When you read the news or hear a stock tip, the very first question you ask is not, "Is this a good investment?" but, "Is this inside my circle of competence?" If the answer is no, you discard it immediately. It doesn't matter if it's the most exciting story in the market. A company pioneering nuclear fusion might be a world-changing enterprise, but if you don't have a PhD in physics, you have no business trying to evaluate its prospects. You simply say, "Too hard," and move on. This discipline will save you from countless mistakes and wasted hours of research. Step 3 is to actively work to expand your circle, but to do it slowly and deliberately. If you want to understand the banking industry, for example, don't start by trying to analyze a massive, complex institution like JP Morgan Chase. Start by reading the annual reports of a small, local community bank. Their business model is simple. They take in deposits, and they lend out money for mortgages and small business loans. Read everything you can. Understand the concepts of net interest margin and loan loss provisions. Once you master this simple model, you can gradually move on to more complex institutions. You expand your circle not by jumping into the deep end, but by gradually wading out from the shore. This deliberate, patient approach to financial education is the key to building real, durable knowledge that leads to long-term portfolio growth and financial independence. Now, to truly appreciate the power of this mental model, we must examine its opposite. we must explore the path of the 99%, the antithesis of the circle of competence. This is the path of chasing complexity, of following the herd into the latest, hottest sector, regardless of one's own understanding. The most spectacular example of this in modern history is, without a doubt, the dot-com bubble of the late 1990s. During this period, the normal rules of business and valuation were thrown out the window. Any company with a .com at the end of its name was suddenly worth billions of dollars, even if it had no revenue, no profits, and no clear path to ever making money. The public was mesmerized by a new, complex technology, the Internet, and because they didn't understand it, they assumed it must be magic. They were deep in the throes of the Dunning-Kruger effect, on a societal scale. People who had spent their careers as dentists, lawyers, and shopkeepers were suddenly day trading stocks of companies building fiber optic networks, or B2, e-commerce platforms. Could any of them explain to a fifth grader how these businesses worked or how they would eventually turn a profit? Absolutely not. They were buying a story, a narrative of a new economy where profits didn't matter. They were buying ticker symbols attached to vague, exciting concepts. Take a company like Pets.com. Its business model seemed simple on the surface. Sell pet supplies online. But the underlying economics were a disaster. The cost of acquiring a customer and shipping a heavy bag of dog food far exceeded the revenue from the sale. Yet, investors, caught up in the mania, poured hundreds of millions of dollars into it. They didn't understand the simple, brutal math of logistics and customer acquisition costs. They just knew it was an internet stock, and that was enough. The consequences were catastrophic. When the bubble burst in 2000, trillions of dollars of paper wealth evaporated. People lost their life savings, their retirement funds, their homes. They had ventured far outside their circle of competence, armed only with hope and hype, and they paid the ultimate price. This isn't ancient history. The same story repeats itself in every market cycle. In the 2007-2008 financial crisis, it was investors buying complex mortgage-backed securities they didn't understand. In more recent times, it has been people pouring money into speculative cryptocurrencies or pre-revenue electric vehicle companies based on a charismatic CEO and a futuristic prototype. The pattern is always the same. Complexity and jargon are used to mask a lack of underlying business substance, and investors who stray outside what they can simply explain get burned. The intelligent investor, the one practicing the CEO mindset, understands that their capital is too precious to be gambled on things they don't comprehend. So how does this disciplined adherence to simplicity and the circle of competence translate into a direct, quantifiable financial advantage? The connection is profound and multifaceted. First, it dramatically reduces the number of mistakes you make. Investment legend Peter Lynch once said, "In this business, if you're good, you're right 6 times out of 10. You're never going to be right 9 times out of 10. The key to successful long-term investing is not about hitting home runs every time. It's about avoiding the strikeouts, the catastrophic losses that can cripple your portfolio. By staying within your circle of competence, you are playing a game where you have an edge. You are far less likely to misinterpret the competitive landscape, to underestimate the risks, or to overpay for a business whose future you can't reasonably predict. Fewer mistakes mean less capital lost, which is the essential first step to building wealth. Second, it leads to a much lower portfolio turnover. When you buy businesses you don't really understand, you are more likely to get scared out of your position by a bad news headline or a short-term price drop. Your conviction is shallow because your knowledge is shallow. This constant buying and selling, or churning, is a wealth-destroying activity. It racks up transaction costs and, more importantly, triggers capital gains taxes that act as a massive drag on your compounding machine. Conversely, when you own a simple business like See's Candies or Coca-Cola, you understand its durable nature. A bad quarter or a negative news cycle doesn't shake your conviction. You are more inclined to hold for the long term, allowing the miracle of compounding to work its magic, tax-deferred, for years or even decades. This patience, born of simple understanding, is the secret sauce of all great fortunes. Finally, staying within your circle of competence allows you to act decisively when opportunities arise. Buffett famously said he could be greedy when others are fearful because he understands the businesses he owns. During a market panic, the prices of all stocks fall, the good and the bad. The investor with a portfolio of complex, high-flying tech stocks is paralyzed with fear. They have no way of knowing if the 50% price drop is a temporary blip or a sign of permanent business impairment. But the investor who owns a simple, profitable railroad or beverage company can look at the chaos and see a wonderful opportunity to buy more of a great business at a discount. Their deep understanding gives them the courage to act. This ability to deploy capital intelligently during downturns is what separates the amateur from the professional, and is a direct result of the clarity provided by the fifth-grader test. It's how you turn market fear into personal financial freedom. Now that we have established the foundation of simplicity through the circle of competence, we must move to the next pillar. It's not enough for a business to be simple to understand. It must also possess a simple, durable reason for its success. This is what Buffett famously calls the moat. A great business, like a great medieval castle, must have a protective barrier around it, a structural advantage that keeps competitors at bay and allows the castle to remain prosperous. The beauty of this concept is that the most powerful moats are often the simplest to identify and explain. And there is no better example of a simple business with a gigantic, understandable moat than another of Buffett's most famous and profitable investments, the Coca-Cola Company. Our second foundational anecdote takes us to the late 1980s. The stock market was still reeling from the crash of October 1987, known as Black Monday. Fear was palpable. Investors were convinced that the good times were over. It was in this environment of pessimism that Warren Buffett, through Berkshire Hathaway, began to invest enormous sums of money into a single company, Coca-Cola. Between 1988 and 1989, he invested over $1 billion, eventually acquiring a stake of around 7% of the entire company. To many observers at the time, this seemed like a strange, even reckless move. Coca-Cola was already a massive, mature company. How much more could it possibly grow? Wasn't this just a boring, old economy stock? But Buffett saw something else. He saw a business of breathtaking simplicity and power. What does Coca-Cola do? A fifth grader can tell you. They make a brown, sugary syrup, they mix it with carbonated water, and they sell it all over the world. That's it. The formula is secret, but the business model is an open book. But the simplicity of the product masked the immensity of its competitive advantage, its moat. Buffett wasn't just buying a soft drink company. He was buying a piece of the human mind. He articulated the moat with his signature clarity. He would ask people, if you were given $100 billion and told to build a beverage company to knock Coca-Cola off its pedestal, could you do it? The answer is almost certainly no. You could create a drink that tasted identical, you could even sell it for cheaper, but you could not replicate the brand. The word Coca-Cola is one of the most recognized phrases on the planet, second only to okay. It is seared into the collective consciousness of humanity. It's associated with happiness, with refreshment, with moments shared with family and friends. This mental real estate, this brand, is a moat of near impregnable depth. It allows Coke to charge a premium for what is essentially sugar water. A customer standing in front of a vending machine will instinctively reach for the familiar red can, even if a generic cola next to it is 25 cents cheaper. That is the power of the brand moat in action. Furthermore, Coca-Cola had built a second, equally powerful moat, a global distribution network that was unparalleled. Through a system of bottlers and distributors, they had placed their products within an arm's reach of desire for billions of people. Whether you are in a bustling city square in Tokyo or a remote village in Africa, you can probably find a Coke. This distribution system, built over a century, is a massive physical barrier to entry for any potential competitor. Buffett understood that these two moats, the intangible power of the brand and the tangible power of the distribution network, were simple to understand but incredibly difficult to replicate. This combination created a business that was a virtual cash machine, gushing profits year after year with very little need for additional capital. His billion-dollar bet, made when others were fearful, turned into a stake now worth over $25 billion, not including the tens of billions in dividends Berkshire has received over the decades. It's a testament to the financial transformation that occurs when you identify a company with a simple business model, protected by a simple, powerful, and understandable moat. The Coca-Cola story demonstrates the immense financial power of a simple, durable moat. But what is happening in our brains that gives these moats their strength? The underlying psychological principles are rooted in the way our minds process information and make decisions. The human brain is, by nature, lazy. It seeks to conserve energy. To do this, it relies on mental shortcuts, or heuristics, to make thousands of decisions every day without having to perform a deep, analytical evaluation each time. A brand like Coca-Cola is a powerful heuristic. When we are thirsty and see that familiar red logo, our brain doesn't engage in a complex calculation of price versus quality versus taste compared to all other available options. It takes a shortcut. It thinks, I know Coca-Cola. I've had it before. It's reliable. It will satisfy my thirst. I'll choose that. This is known as the availability heuristic and brand familiarity. We trust what we know. This loyalty, built up over decades of consistent experience and massive advertising spend, becomes an automatic, subconscious habit for billions of people. It's a habit that is incredibly difficult for a new competitor to break. Another powerful psychological principle at play is social proof. We are social creatures, and we often look to the behavior of others to guide our own choices, especially in situations of uncertainty. When we see Coca-Cola being consumed everywhere, at sporting events, in movies, by our friends and family, it reinforces the idea that it is the correct choice. This creates a self-perpetuating cycle. The more people drink Coke, the more visible it is, which in turn encourages even more people to drink it. A business with a strong moat taps into these deep-seated psychological tendencies. Whether it's the brand loyalty of a Coca-Cola, the high switching costs of moving all your data from Apple's ecosystem to Android's, or the network effect of a platform like Facebook or Visa where the value increases as more people use it. All of these moats work because they align with and exploit the predictable patterns of human psychology. Understanding this connection is a key part of financial education. It elevates you from a simple stock picker to a true business analyst with a CEO mindset. Recognizing the power of moats is one thing. Being able to consistently identify them in the wild is another. This requires an applied mental model, a practical checklist you can use to analyze any business and determine the strength and durability of its competitive advantages. The beauty of the fifth grader test is that the strongest moats are usually the easiest to explain. Here is a blueprint for identifying them. First on the checklist is the brand moat, as we saw with Coca-Cola and See's candies. Ask yourself, does this company's name alone allow it to charge a premium price for a product that is otherwise a commodity? Think of Tiffany & Company selling jewelry, or Nike selling athletic shoes. You are paying extra for the brand, for the status and perceived quality it represents. A fifth grader can understand that a swoosh on a sneaker makes it more desirable. Second is the switching cost moat. This exists when it is too expensive, time-consuming, or risky for a customer to switch from one provider to another. Think of your local bank. Moving your direct deposits, automatic bill payments, and linked accounts is a massive headache. As a result, you are likely to stay with your bank even if a competitor offers a slightly better interest rate. Another classic example is enterprise software companies like Microsoft or Oracle. Once a large corporation has built its entire workflow around their software, the cost and risk of switching to a new system is astronomical. A fifth grader can understand that it's a pain to learn a whole new video game system once you're used to your old one. Third is the network effect moat. This is one of the most powerful moats in the digital age. It occurs when a service becomes more valuable as more people use it. Think of a credit card company like American Express or Visa. The more merchants that accept the card, the more useful it is for consumers. The more consumers that carry the card, the more essential it is for merchants to accept it. It's a virtuous cycle. Facebook, YouTube, and eBay are other prime examples. A fifth grader gets this instantly. A telephone is useless if only one person has one. Fourth is the cost advantage moat. This can come from two sources: process or scale. A process advantage is a unique, proprietary way of doing something cheaper than anyone else, like Toyota's famous manufacturing system. A scale advantage comes from being so large that your per-unit costs are lower than smaller competitors. Think of Walmart or Amazon. Their immense scale allows them to negotiate rock-bottom prices from suppliers and invest in logistics networks that no smaller rival can match, allowing them to offer lower prices to consumers. A fifth grader understands that buying in bulk is cheaper. By systematically running a potential investment through this checklist, you can translate the abstract idea of a moat into a concrete analysis. The key is to demand a simple, clear answer. If you can't explain the moat to a fifth grader using one of these categories, it probably isn't a strong moat. To fully grasp the wisdom of investing only in businesses with simple, durable moats, we must look at the graveyard of companies that followed the opposite path. The antithesis is the company with a fleeting, complex, or non-existent competitive advantage. This is the path of the 99% of businesses that ultimately fail or stagnate. Think of the countless technology companies that soared to prominence based on a single hit product or a temporary technological edge, only to be wiped out by the next innovation. A classic example is the rise and fall of Palm, the company that pioneered the Personal Digital Assistant, or PDA, with the Palm Pilot in the 1990s. For a time, they dominated the market. Their moat seemed to be their technology and early lead, but it was a shallow moat. The technology was easily replicable, and more importantly, it was destined to be integrated into other devices. When companies like BlackBerry added email to phones and Apple launched the iPhone, which combined a phone, an iPod, and an internet communicator into one device, Palm's single-purpose PDA was rendered obsolete almost overnight. An investor in Palm in the late 90s might have been impressed by its complex technology and market leadership, but they would have struggled to explain to a fifth grader why someone would continue to carry a separate Palm Pilot once their phone could do everything it could, and more. The moat was not durable. Another common pitfall is mistaking high growth for a moat. Many companies, especially in retail and restaurants, can grow very quickly for a few years by simply opening new locations. Investors get excited by the surging revenue and stock price, but growth itself is not a moat. Consider a trendy fashion retailer. They might have a great run for a few years, but fashion is fickle. What's hot today is forgotten tomorrow. Without a durable brand moat like Nike's, there is nothing to stop customers from flocking to the next new thing. The company has no pricing power and no loyal customer base. The same is true for many restaurant chains that expand too quickly, only to find that their initial popularity was a fad, not a lasting competitive advantage. The intelligent investor, the one focused on long-term wealth creation, is not seduced by temporary growth or complex technology. They are looking for structural advantages, simple moats that will stand the test of time. They know that the stock market is a relentless machine for exposing companies without one. The presence of a simple, understandable moat has a direct and massive impact on a company's financial performance and, consequently, on your investment returns. This is where the concept connects directly to the numbers on a balance sheet and income statement. The most important financial benefit of a strong moat is pricing power. A company with a strong brand or high switching costs can raise its prices year after year without losing customers. This pricing power flows directly to the bottom line, resulting in high and stable profit margins. When you look at the financial statements of companies like Coca-Cola, Moody's, or Hershey, you will see consistently high gross and operating margins, far superior to their competitors who sell more commoditized products. This is the moat made visible in the numbers. Second, a strong moat leads to a high return on invested capital, or ROIC. This is one of the most important metrics for evaluating a business. It measures how much profit a company generates for every dollar of capital it invests back into its operations. A company with a great moat, like See's Candies, doesn't need to spend massive amounts of money on research and development or new factories to keep its customers. The brand does the heavy lifting. As a result, it can generate huge profits with very little capital, leading to a sky-high ROIC. Businesses that can consistently earn high returns on capital are compounding machines. They can reinvest their profits back into the business at high rates, creating a snowball of value for shareholders. This is the engine of massive portfolio growth. In contrast, a company in a highly competitive industry with no moat, like an airline or a typical automaker, has to constantly spend enormous sums on new planes or factories just to stay competitive. Their returns on capital are low and cyclical. They are running on a capital-intensive treadmill that chews up cash and creates very little long-term value for shareholders. By focusing your stock picking on simple businesses with simple, powerful moats, you are systematically tilting your asset allocation towards these high-quality, capital-light compounders. This is the secret to not just beating the market, but doing so with less risk. You are investing in financial fortresses, and the financial statements will prove it. We have established that a great investment must be simple to understand and protected by a simple, durable moat. But even the best business in the world is a terrible investment if you pay too high a price for it. This brings us to our third pillar, simplicity in valuation. The principle here is a natural extension of the fifth grader test. If a business is truly simple, then figuring out what it's worth should also be a relatively straightforward exercise. You shouldn't need a 100-page spreadsheet with dozens of uncertain variables projected out 10 years into the future. If you do, you're probably deceiving yourself. The need for a complex valuation model is often a red flag that the underlying business itself is too complex or unpredictable. To understand this, we turn to one of the most bizarre and instructive episodes in Buffett's career, the American Express salad oil scandal of 1963. In the early 1960s, American Express was a respected but somewhat stodgy company, primarily known for its travelers' checks and credit card, which was still a relatively new product. A major, but less understood, part of their business was in warehousing. Through a subsidiary, they would inspect and certify commodities stored in warehouses, and then issue receipts against that inventory. Banks would then lend money to the commodity owners with these receipts as collateral. It was a complex, opaque, and ultimately peripheral part of their business. In 1963, a small company in New Jersey called the Allied Crude Vegetable Oil Refining Corporation, a major customer of American Express's warehousing division, defaulted on its loans. It was then discovered that Allied had perpetrated a massive fraud. Their giant storage tanks, which American Express had certified as being full of valuable salad oil, were mostly full of seawater, with only a thin layer of oil floating on top. The company was a sham, and the collateral backing hundreds of millions of dollars in loans was worthless. When the fraud was revealed, Wall Street panicked. The market feared that American Express would be held liable for all the fraudulent receipts, and that the scandal would bankrupt the company. The stock price was cut in half, plunging from over $60 a share to $35. The sentiment was overwhelmingly negative. Everyone was focused on the complexity of the warehousing division, the legal liabilities, and the potential for ruin. But Warren Buffett, then a young, up-and-coming fund manager, decided to apply a lens of simplicity. He ignored the complex warehousing scandal, which he knew he couldn't fully analyze. He considered it a, quote, too hard pile. Instead, he asked a simple question that any fifth grader could understand. Are people still using American Express travelers' checks and credit cards? He decided to do some field research. He went to restaurants and travel agencies. He talked to cashiers and customers. He observed that people were not only still using the products, they were using them more than ever. The scandal, which was front-page news on Wall Street, was a non-event for the average consumer. The core businesses, the simple and understandable parts of American Express, were completely unaffected. He realized that the brand and the trust in the core products represented an enormous, durable value that the market was completely ignoring because it was fixated on the complex, scary part of the story. He did a simple, back-of-the-envelope valuation. He calculated the owner earnings of the traveler's check and credit card businesses and found that the company was earning a significant amount per share from these operations alone. At the new collapsed stock price of $35, he was essentially getting the entire warehousing business, with all its troubles, for free, and was buying the crown jewel consumer finance businesses at a ridiculously cheap price. He invested 40% of his partnership's capital into American Express stock, his largest investment ever at the time. Over the next few years, as the company settled the legal claims for far less than feared and the power of its core businesses continued to shine, the stock price soared, making an immense fortune for Buffett and his investors. This story is the perfect embodiment of simplicity and valuation. He cut through the noise, ignored the complexity he couldn't understand, focused on the simple, durable value drivers, and made a fortune as a result. The salad oil scandal reveals how a focus on simplicity can lead to incredible investment opportunities. The psychological principle it overrides is one of the most powerful and distorting forces in finance, anchoring bias, often combined with what's known as the storytelling fallacy. Anchoring bias is our tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. In the case of American Express, the market anchored on the horrifying story of the fraud and the potential for massive legal liability. The headline number, the $150 million of potential losses, became the anchor that dragged the perception of the entire company down with it. Investors couldn't see past that one scary, complex issue. They were so focused on the potential loss that they failed to properly assess the ongoing value of the core business. Buffett avoided this trap by deliberately creating his own anchor. His anchor wasn't the scandal. It was the simple, observable reality of the business's continuing earnings power from its main operations. The storytelling fallacy, a close cousin, is our brain's desire to create a coherent and simple narrative to explain complex events. The story in 1963 was, American Express is a fraudulent company on the brink of collapse. It was a simple, compelling, and utterly wrong story. Complex valuation models often fall prey to this same fallacy. An analyst can build a spreadsheet with dozens of inputs, but ultimately, those inputs are just assumptions that are used to justify a pre-existing story or belief about the company's future. If the story is, "This is the next revolutionary tech company," the analyst will subconsciously tweak the growth and margin assumptions until the model produces a high valuation that confirms the narrative. Buffett's approach of using a simple, back-of-the-envelope valuation based on current, provable earnings power is a powerful antidote to this. It forces you to ground your valuation in reality, not in a speculative story about the future. It's a mental discipline that prevents you from getting caught up in the market's prevailing and often misleading narrative. It forces you to ask, what is this business worth right now, based on what I can see and understand simply? This question is a powerful shield against the emotional tides of fear and greed that sweep through Wall Street. So how can an ordinary investor apply this principle of simple valuation? The key is to adopt a mental model that prioritizes understandable reality over speculative complexity. This is the back-of-the-envelope valuation blueprint. The goal is not to pinpoint a precise intrinsic value down to the penny, but to determine if a company is available at a price that is obviously, screamingly cheap. Step 1 is to focus on what Buffett calls owner earnings. This is a more realistic measure of a business's profitability than the standard net income you see on financial statements. The simple formula is net income plus depreciation and amortization maintenance capital expenditures. The first two parts are easy to find on an income statement and cash flow statement. The third part, maintenance capex, is the tricky one. It's the amount of money a company has to spend each year just to maintain its current level of business. to keep the machinery running and the stores looking fresh. Companies don't explicitly report this number, so you have to estimate it. For a simple, stable business, you can often use the total capital expenditures as a conservative proxy. For a fifth grader, you could explain it like this. Owner earnings is the amount of cash the owner could theoretically pull out of the business at the end of the year without hurting its operations. Step 2 is to compare these owner earnings to the company's total market price, or market capitalization. This gives you an earnings yield. If a company earns $1 billion in owner earnings and its market cap is $10 billion, it has an earnings yield of 10%. This is a powerful, simple metric. You can now compare this yield to other investments. For example, if the 10-year U.S. Treasury bond is yielding 4%, a business with a stable 10% earnings yield looks very attractive. You are essentially getting a bond that pays 10% and has the potential to grow over time. Step 3 is to demand a margin of safety, a concept from Buffett's mentor, Benjamin Graham. This means you only buy when the earnings yield is significantly higher than what you could get from a risk-free investment like a government bond. You want to buy the business for far less than you think it's conservatively worth. This margin of safety is your protection against bad luck, errors in judgment, or unforeseen problems. The American Express investment was a perfect example. The earnings yield on the core business was so high at the panicked stock price that Buffett had an enormous margin of safety, even if things went worse than expected with the salad oil scandal. This simple, three-step process, calculate owner earnings, determine the earnings yield, and demand a margin of safety, keeps you anchored in the reality of the business. It's a valuation method that a fifth grader could understand in principle, and it is infinitely more powerful than the complex discounted cash flow models that try to predict the future with false precision. The antithesis of this simple approach is what we see every day in the financial media, especially during speculative bubbles. This is the path of valuing complexity, of inventing new metrics to justify absurd prices for businesses that have no earnings. This is the path of the 99% of investors who get caught in manias. During the dot-com bubble, since most internet companies had no earnings, Wall Street had to invent new valuation metrics. They started valuing companies based on price to eyeballs, or price per click. The logic was that if a website had a lot of users, eyeballs, it must be valuable, even if it had no way of making money from them. This was a complete departure from the simple, time-tested logic of business. A business is worth the cash it can produce for its owners over its lifetime, period. Valuing a company on any other basis is not investing. It is speculating. We see the same pattern today. Analysts create complex models for pre-revenue electric vehicle companies, projecting vehicle deliveries and profit margins a decade into the future. They assign multi-billion-dollar valuations to biotech firms with a single drug in early-stage trials. These valuations are not based on the simple reality of current earnings power. They are pure narrative, pure story. The complexity of the models gives them a veneer of scientific rigor, but it's an illusion. As the saying goes, garbage in, garbage out. If your assumptions about the future are wrong, and they almost always are, your complex model will produce a precise but precisely wrong answer. The investor who falls for this trap is taking on an enormous amount of risk. They have no margin of safety, because the entire valuation is predicated on a rosy future scenario coming to pass. When that narrative breaks, as it inevitably does for most of these speculative companies, the stock price collapses, because there is no bedrock of current earnings power to support it. The investor is left holding a worthless stock and a fancy spreadsheet. The simple valuation approach of focusing on owner earnings protects you from this fate. It forces you to be an intelligent investor, not a speculator, and that is a crucial distinction for anyone serious about long-term wealth management. The direct financial connection between simplicity in valuation and portfolio growth is profound. First and foremost, it provides the margin of safety, which is the central concept of value investing. By buying a simple, understandable business for significantly less than its conservatively estimated intrinsic value, you build a powerful buffer into your investment. If you are wrong about the company's future growth, the margin of safety protects your principal. If you are right, you get the double-barreled benefit of the business's value increasing and the valuation multiple the market assigns to it expanding. This is how multi-bagger returns are generated. This is the source of massive capital gains. Second, this approach allows you to take advantage of market irrationality. The market is often most inefficient when it comes to situations involving complexity and fear, like the salad oil scandal. Most investors will run for the hills. The investor armed with the tool of simple valuation can calmly dissect the situation, separate the temporary, complex problem from the simple, durable value, and make a fortune by acting rationally when others are panicking. This is a repeatable strategy for beating the market over the long term. Finally, simplicity in valuation builds conviction. When you have valued a business using a simple, conservative method based on its current earnings power, your belief in the investment is grounded in a rock-solid foundation. You know what it's worth. So if the stock price drops 20% or 30% due to a general market downturn, you don't panic, you see it as an opportunity. You think, the market is now offering me a 12% earnings yield on this great business, when I was happy to buy it at an 8% yield last month. I should buy more. This ability to think and act this way during periods of turmoil is the single greatest determinant of an investor's ultimate success. It is an attitude born directly from the confidence that a simple valuation provides, a key step on the road to financial independence. We've now established that a great investment should be a simple business, with a simple moat, bought at a simple, attractive price. But there is one more crucial human element to the equation: the people running the show. This brings us to our fourth pillar, the management test, which champions simple character over complex genius. The principle here is that the people leading the company should be just as understandable as the business itself. You are not looking for a messianic visionary with a 200-page strategic plan to conquer the world. You are looking for managers who are rational, honest, and treat shareholders as true partners. Their motivations should be simple and clear. Often, the best managers are not the ones on the cover of magazines, but the ones quietly compounding capital for their shareholders year after year. For the quintessential story on this topic, we must travel to Omaha, Nebraska, to the story of Buffett's acquisition of the Nebraska Furniture Mart and his lifelong relationship with its founder, the legendary Rose Blumkin, or Mrs. B. In 1983, Warren Buffett decided to buy the Nebraska Furniture Mart, a single, gigantic furniture store in Omaha that was, by far, the largest and most profitable in the country. The story of the acquisition is a masterclass in simplicity and character. Mrs. B was a Russian immigrant who arrived in America unable to speak a word of English. She started the business in 1937 with a $500 loan from her brother. Her business philosophy was brutally simple and she repeated it constantly: sell cheap and tell the truth. She worked tirelessly, building the business into a local institution with over $100 million in annual sales, dominating its market. When Buffett decided he wanted to buy the company, there was no army of investment bankers, no months of due diligence, no teams of lawyers haggling over complex contractual clauses. Buffett went to see the 89-year-old Mrs. B. He asked her how much she wanted. She named a price. He looked at her simple, hand-kept books, which were a testament to the business's phenomenal and consistent profitability. He knew her reputation in the community for absolute integrity. He knew her sons, who were also in the business, were rational and hardworking. Her character and track record were all the due diligence he needed. The deal was sealed with a simple 2-page contract and a handshake. He paid approximately $60 million for 90% of the business, without ever getting an audit. He trusted Mrs. B's character more than he would have trusted 100 pages from a top accounting firm. The story gets even better. After selling the company, Mrs. B, then in her 90s, continued to work at the store every single day. Eventually, at age 95, she had a disagreement with her grandsons about how the store was being run and retired in frustration. But retirement didn't suit her. A few months later, she opened a rival store right across the street called Mrs. B's Clearance and Factory Outlet. It quickly became the third largest carpet outlet in Omaha. Buffett, as the owner of her competitor, loved it. He eventually bought her new store and merged it back into the main company. She continued working until she was 103 years old. The relationship between Buffett and the Blumkin family was built on a foundation of simple, old-fashioned values: honesty, hard work, and a relentless focus on the customer. Mrs. B wasn't a celebrity CEO. She didn't give grand speeches about corporate synergy or disruptive innovation. Her genius was in her simple, unwavering character and business philosophy. Buffett understood that when you partner with people of this caliber, you don't need complex oversight. You just need to let them do what they do best. This is a critical lesson for any retail investor or entrepreneur. The character of the management team is a leading indicator of future success. You want leaders whose motivations are as simple and clear as Mrs. B's. Create value for the customer, and the profits will follow. The story of Mrs. B is heartwarming, but it also highlights a deep psychological principle that trips up many investors. We are often susceptible to the halo effect. This is a cognitive bias where our overall impression of a person, often based on a single positive trait like charisma or eloquence, influences our judgments about their specific abilities. In the business world, this often manifests as the celebrity CEO phenomenon. A CEO might be a fantastic public speaker, have a compelling personal story, and be a master of painting a grand vision for the future. We see this charismatic leader and the halo effect kicks in. We automatically assume they must also be a brilliant capital allocator, an expert in operations, and a person of high integrity. This is a dangerous assumption. History is littered with examples of charismatic CEOs who were masters of storytelling but disastrous for shareholders. They used their charisma to sell a complex vision that masked underlying business problems or, in the worst cases, outright fraud. Think of Adam Neumann at WeWork, who sold a vision of elevating the world's consciousness while burning through billions of dollars of investor capital in an unsustainable real estate business. Or Elizabeth Holmes at Theranos, whose compelling personal story and vision for revolutionizing healthcare masked a complete technological failure. Buffett's focus on simple character over complex genius is a direct antidote to the halo effect. He isn't looking for a savior or a visionary, he is looking for a steward. He wants a manager who thinks like an owner, who is rational in their decision-making, and who communicates with shareholders in a simple, honest way. The management test, therefore, is not about being impressed, it's about being able to trust. Trust is built on a track record of rational behavior and honest communication, not on a flashy presentation or a grand, complicated vision. By deliberately looking for these simple traits of character, you can avoid being seduced by the dangerous halo of a celebrity CEO and make a much more sober and profitable assessment of the people you are entrusting with your capital. How can an outside investor, who doesn't have the luxury of sitting down with management for a handshake deal, apply this principle? You can build a practical mental model by becoming a business detective, and your primary clue is the company's annual report, specifically the chairman's letter to shareholders. This letter is where management speaks directly to you, the owner. Here is a blueprint, a checklist for evaluating management's character through their writing. First, do they speak in plain English? A management team that uses simple, clear language is usually one that has a simple, clear understanding of its business. A letter filled with jargon, buzzwords, and corporate speak is often a red flag that management is either trying to hide something or doesn't fully grasp the fundamentals themselves. As Buffett says, if you can't write it down, you don't know it. Second, do they admit mistakes? This is perhaps the most important test of character. Every business makes mistakes. Honest and rational managers admit them, explain what they learned, and detail how they will avoid repeating them. Managers who never admit a mistake, who blame every problem on external factors like the economy or competition, are not to be trusted. They lack the intellectual honesty required for effective leadership and capital allocation. Third, do they explain the how and why, not just the what? A poor shareholder letter will just list the financial results. A good one will explain the underlying business reasons for those results. If profits went up, Was it because of price increases, volume growth, or cost cutting? If the company made an acquisition, what is the simple strategic rationale behind it? You are looking for a management team that educates you as a shareholder, not one that just reports numbers. Fourth, is their compensation tied to rational, long-term business performance? Look at the proxy statement. Are executive bonuses tied to metrics that actually create shareholder value, like return on invested capital, or are they tied to fuzzy metrics or simply the stock price, which can encourage short-term value-destroying behavior? You want managers whose financial incentives are aligned with yours as a long-term owner. By using this simple checklist as you read a company's reports, you can get a remarkably accurate picture of the character and rationality of the management team. This is a crucial part of the stock market analysis that most investors skip, but it is essential for building a portfolio of companies you can truly believe in. The antithesis of this approach is the all-too-common path of investing based on the cult of personality surrounding a visionary CEO, often in a complex and hard-to-understand industry. This is where the 99% often get into trouble, mistaking charisma for competence and a good story for a good business. The most infamous example of this is the case of Enron and its leadership team, Kenneth Lay and Jeffrey Skilling. Enron was an incredibly complex business. It started as a natural gas pipeline company, but morphed into a dizzyingly complicated energy trading firm that dealt in obscure financial derivatives. Nobody, not even seasoned Wall Street analysts, could truly understand how it made money. The financial statements were deliberately opaque and confusing. But what Enron had was a charismatic leadership team that sold a compelling story. They were pioneers of a new economy, an asset-light business model that was the wave of the future. Skilling, in particular, was seen as a brilliant, once-in-a-generation genius. Investors, seduced by the halo effect and intimidated by the complexity of the business, simply trusted the story and the storyteller. They ignored the fact that management never explained their business in simple terms. They ignored the convoluted financial reports. They ignored the lack of genuine cash flow. They invested in the genius, not the business. The result was one of the largest corporate frauds in history. The entire enterprise was a house of cards, built on accounting tricks and hidden debt. When it collapsed, thousands of employees lost their jobs and their life savings, and investors lost billions. Enron is an extreme example, but the underlying lesson is universal. When you invest in a company where the primary appeal is the supposed genius of its leader, rather than the simple, understandable economics of the business itself, you are taking a massive risk. You are betting on one person, and you are often doing so in a business that is too complex to analyze on its own merits. The intelligent investor, the one with the CEO mindset, knows that a great business should not depend on a single genius to run it. As Buffett likes to say, you should invest in a business that is so good that an idiot can run it, because sooner or later one will. The direct financial connection between partnering with simple, honest management and achieving superior portfolio growth is one of the most underappreciated aspects of value investing. It all comes down to one crucial activity: capital allocation. A CEO's most important job is deciding what to do with the company's profits. Should they reinvest them back into the business, acquire another company, pay down debt, buy back stock, or pay a dividend? These are the executive decision-making moments that create or destroy enormous amounts of shareholder value over time. Rational, shareholder-focused management, like the kind Buffett seeks out, excels at this. They will only reinvest capital in projects that they believe will earn a high rate of return. They will only make acquisitions when the price is sensible and the strategic fit is clear. They will buy back their own stock when they believe it is trading for less than its intrinsic value, effectively increasing each shareholder's ownership stake in the business. And if they can't find any intelligent use for the capital, they will return it to shareholders via dividends. This rational, disciplined approach to capital allocation is a powerful, silent engine of compounding. Conversely, the celebrity CEO, often driven by ego and a desire to build a bigger empire, is frequently a terrible capital allocator. They tend to overpay for splashy, transformational acquisitions that rarely work out, They might pour money into pet projects with low returns. They often issue stock to fund these adventures, diluting existing shareholders. This value-destructive behavior is a massive drag on long-term returns. By using the management test to filter for honest, rational, and disciplined capital allocators, you are directly aligning your portfolio with companies that are far more likely to compound your capital at high rates over the long term. This isn't a minor detail. It is the very heart of what separates a mediocre business from a truly great wealth-building investment. It is the financial manifestation of simple, good character. This brings us to the fifth and final pillar, the ultimate culmination of this entire philosophy. This is where the simple, understandable nature of your investments pays its greatest dividend. This is the pillar of the panic button, and the principle that simplicity breeds conviction. The ultimate test of any investment strategy is not how it performs during a bull market when everything is going up, but how it allows you to behave during the inevitable panics, crashes, and corrections. It is in these moments of extreme fear and uncertainty that fortunes are made or lost. And the secret to being on the right side of that equation is conviction. A deep, unshakable belief in the value of what you own. This conviction is not born of arrogance or blind faith. It is the natural byproduct of owning simple businesses that you understand completely. For our final anecdote, we must look to Buffett's investment in the Washington Post Company during the brutal bear market of 1973-1974. The early 1970s were a difficult time for America and the stock market. The Vietnam War was ending in turmoil, the Watergate scandal was eroding faith in government, and an oil crisis was sending inflation and unemployment soaring. The stock market entered a prolonged and vicious downturn. From its peak in 1973 to its bottom in late 1974, the market lost nearly 50% of its value. It was a period of profound pessimism. High-quality blue-chip stocks were being thrown out with the trash. It was in this environment that Buffett saw an opportunity in the Washington Post Company. At the time, the Washington Post was a media empire, but its crown jewel was the newspaper itself, which had recently gained global fame for its reporting on the Watergate scandal by Bob Woodward and Carl Bernstein. The business model was, once again, beautifully simple. The newspaper held a dominant, near-monopolistic position in the lucrative Washington, D.C. market. This dominance gave it immense pricing power with advertisers. Businesses had to advertise in the Post to reach the city's affluent and powerful population. This was a simple, understandable local media moat. Despite the quality of the business, its stock was getting hammered along with the rest of the market. The entire company, which also owned Newsweek magazine and several television stations, had a market capitalization of around $80 million. Buffett, applying his simple valuation techniques, did some analysis. He realized that the television stations alone were probably worth more than the entire $80 million market cap. This meant he was essentially getting the world-famous Washington Post newspaper and Newsweek magazine for free. It was an absurdly cheap price for a collection of high-quality, simple-to-understand media assets. While the rest of the world was panicking about the economy and the stock market, Buffett was calmly and aggressively buying shares. He knew the stock price was falling not because the Washington Post had suddenly become a bad business, but because of a wave of irrational fear sweeping the entire market. His understanding of the business's simple, durable moat gave him the conviction to act decisively. He invested over $10 million, becoming a major shareholder and a director on the company's board. That $10 million investment would eventually grow to be worth over $1 billion, a 100-fold return. This is the ultimate payoff of the fifth-grader test. Because he could explain to himself with absolute clarity why the Washington Post was a great business, he was psychologically immune to the market's panic. He didn't need to guess about the future of the economy. He just needed to know that people in Washington, D.C. would still be reading the newspaper and watching the local news in 5 or 10 years. That simple insight, and the conviction it created, was the key to one of the greatest investments of his career. The Washington Post story is a powerful example of conviction in action. The psychological forces it overcomes are the two most destructive emotions in investing: loss aversion and herd behavior. Loss aversion is a principle identified by psychologists Daniel Kahneman and Amos Tversky. They discovered that, for the human brain, the pain of a loss is psychologically about twice as powerful as the pleasure of an equivalent gain. This means that seeing your portfolio down $10,000 feels far more intense than the joy of seeing it up $10,000. During a market crash, this cognitive bias is on full display. The pain of seeing their account balances fall triggers a powerful, primal fear in most investors. Their instinct is to sell, to make the pain stop, even if it's the absolute worst thing they could do for their long-term financial health. The second force is herd behavior, our innate tendency to follow the actions of a larger group. When everyone around us is panicking and selling, it feels safe and right to do the same. Going against the herd is psychologically difficult. It feels isolating and risky. These two forces, loss aversion and herd behavior, combine during a market panic to create a vortex of irrational selling that drives prices far below their intrinsic value. The philosophy of simple investing is the ultimate shield against these destructive forces. When you own a portfolio of businesses that you understand as well as Buffett understood the Washington Post, your mental state is completely different. You don't see a falling stock price as a loss. You see it as the market offering you a better price on a wonderful asset. Your anchor is not the fluctuating price, but your unwavering knowledge of the business's simple underlying value. This intellectual foundation breaks the spell of herd behavior. You're no longer following the panicked crowd. You are acting as a rational, independent business analyst. You have flipped the psychological script. Fear is replaced with greed, panic with opportunity. This mental fortitude, which seems like a superpower, is not the result of being emotionless or having nerves of steel. It is the direct, logical outcome of a disciplined investment process built on the bedrock of simplicity. How do you build this kind of unshakable conviction in your own investment process? The applied mental model is to use inversion, a powerful thinking tool popularized by Buffett's partner Charlie Munger. Instead of asking how to succeed, you invert the question and ask what you would need to do to fail. In the context of a market panic, the recipe for failure is clear. Sell good businesses at low prices because of fear. To avoid this fate, you create an inversion checklist to use during a downturn. This is the blueprint for your panic button. When the market is crashing and you feel the urge to sell, you pull out this list. Question 1. Has the simple reason I bought this business fundamentally and permanently changed? Notice the wording. It's not, is the stock price down? It's not, is there bad news about the economy? It's about the core, fifth-grader level investment thesis. For Coca-Cola, the question would be, has something happened that will permanently stop billions of people from wanting a sweet, refreshing beverage? For the Washington Post in 1974, it was, has the paper permanently lost its dominant position in the DC market? In 99% of market panics, the answer to this question will be a resounding no. The simple, long-term business reality is unchanged, even if the short-term stock price is chaotic. Question 2. If I had cash today, would I be excited to buy this business at its current, lower price? This question forces you to reevaluate the investment as a new purchase, not as a position you are losing money on. It frames the situation as an opportunity, not a problem. If the answer is yes, then selling makes absolutely no sense. In fact, it's a signal that you should probably be buying more. Question 3. In 5 or 10 years, is it more likely that this business will be earning more money or less money than it is today? This extends your time horizon beyond the immediate panic. Great, simple businesses tend to become more valuable over time. This question reminds you that short-term market fluctuations are just noise on the path to long-term value creation. By forcing yourself to go through this simple, logical checklist, you interrupt the emotional, fear-driven feedback loop in your brain. You replace panic with process. This is the practical, step-by-step method for cultivating the conviction you need to not just survive market crashes, but to profit from them, paving the way for extraordinary, long-term portfolio growth. To truly understand the power of this conviction, we must once again examine the antithesis, the path of the 99% of investors during a panic. This is the investor whose portfolio is a collection of complex stocks they don't truly understand. Perhaps they own a promising biotech company based on a tip from a friend, a fast-growing but unprofitable software stock they read about online, and a handful of other story stocks, with exciting narratives but no history of consistent earnings. When the market turns, this investor is completely lost. They have no anchor, no bedrock of understanding to hold on to. When the biotech stock falls 50%, they have no way of knowing if the company's drug trial is still on track or if the entire enterprise is doomed. They can't assess the underlying business value because they never understood the science in the first place. When the software stock plunges, they can't tell if it's a temporary setback or if a new competitor has rendered its product obsolete. They are flying blind in a hurricane. The only piece of information they have is the terrifying plunging stock price. Their shallow knowledge leads to shallow conviction. As a result, they are completely at the mercy of their emotions, of loss aversion and herd behavior. They see the sea of red on their screen, they hear the panicked voices on the news, they see everyone else selling, and they capitulate. They sell their holdings near the bottom, locking in devastating losses. Then, they often stay out of the market, too scared to get back in, and miss the subsequent recovery. This is the classic, tragic cycle of the retail investor, buying high in a state of euphoria and selling low in a state of panic. It is the single biggest reason why the average investor's returns dramatically underperform the market averages over time. It is a direct and disastrous consequence of straying outside one's circle of competence and owning complex assets that cannot pass the fifth-grader test. The financial ruin is not caused by the market crash itself, but by the investor's reaction to it, a reaction that was preordained by their initial, flawed stock-picking process. The direct financial connection between simplicity-bred conviction and long-term wealth is the most powerful in all of finance. It is the master key to unlocking the full power of compounding. The greatest fortunes are not built by traders who jump in and out of the market. They are built by long-term owners of great businesses. However, the returns from long-term ownership are not delivered in a straight line. They are punctuated by periods of severe, gut-wrenching volatility. The ability to hold on through these periods is not just important, it is everything. The conviction that comes from simple understanding is what allows you to do this. This has two monumental financial benefits. First, it allows you to avoid the catastrophic mistake of selling at the bottom. By simply not selling during a panic, you preserve your capital and ensure that you are positioned to participate in the market's eventual recovery. This single act of patient inaction is worth more than 1,000 brilliant market timing decisions. It protects your portfolio from its greatest threat, you. Second, and even more powerfully, it gives you the courage to be what Buffett calls greedy when others are fearful. A market crash is the only time when wonderful businesses go on sale. The ability to calmly and rationally add to your positions during these periods of maximum pessimism is the rocket fuel for your long-term returns. Buying a great business at a fair price is a good strategy. Buying that same great business at a bargain price during a panic is how legendary returns are made. It's how Buffett's investment in the Washington Post became a 100-bagger. This is not a strategy reserved for billionaires. It is available to any investor who has done the simple, upfront work of building a portfolio they can understand. The financial transformation is immense. You stop being a victim of the market's mood swings and start being a beneficiary of them. You turn the market's greatest risk, volatility, into your greatest opportunity. This is the final and most profound promise of the fifth-grader test. It is the direct path from being a fearful speculator to being a confident, intelligent investor, capable of building true and lasting financial freedom. You have just been handed a powerful mental tool. It's a key, forged in the simple wisdom of the world's greatest investor. This key is the fifth grader test, and it doesn't just unlock the door to better stock picks, it unlocks a state of mind. It's a mental razor designed to cut through the deafening noise of market hype, the dense fog of financial jargon, and the dangerous allure of complexity. With this single principle, you now have the power to build a fortress of a portfolio, a collection of assets so clear and understandable to you that no market storm can shake your conviction. You have learned to see the world not through the panicked eyes of the crowd, but through the clear, rational lens of a business owner. This is an incredible advantage, a foundation upon which a lifetime of wealth can be built. But a foundation, no matter how strong, is only the beginning of the structure. The fifth grader test is the perfect tool for answering the first and most fundamental question of investing: what to buy. It guides you to simple, high-quality businesses with durable moats. However, this is only one half of the master equation. Owning a wonderful business is critical, but the price you pay for that business is equally critical. The second lock on the vault of financial freedom is understanding when to buy. The most wonderful business in the world can be a terrible investment if purchased at a foolish price. There is a separate but deeply connected mental model that Warren Buffett uses to determine not just the quality of a business, but the opportunity of its price. It's the principle that connects the what with the when. The video that is now appearing on your screen is the key to that second lock. It is the bridge from identifying quality to identifying opportunity. Think of the knowledge you've just gained as one half of a map to a hidden treasure. It's a crucial half, a half that most will never possess. But it is still only half. The video on your screen is the other half of that map. It is the missing link that connects everything you've just learned about business quality to the disciplined art of valuation and timing. Some will stop here. They will be content with the powerful tool they now hold, thinking the job is done. But for those of you who are truly serious about this journey, for those of you on the path to becoming a genuinely intelligent investor and achieving complete financial independence, the next step is not just a choice, it is a necessity. To complete your mental arsenal, to forge a complete and unbreakable investment philosophy, you must continue. The next piece of the puzzle awaits. Click and continue your ascent.